Hi, welcome to the second mini lecture on Chapter 5, and this is going to be covering Learning Outcome 5-3, which is applying internal control principles to cash receipts and cash payments. In our last mini lecture, we covered a lot of ground, and I apologize for the length of that mini lecture. We talked about fraud and internal control and the Sarbanes-Oxley Act, and then we talked about the objectives of internal control, and then we talked about specific control activities. But now we're going to be talking about internal control as it applies specifically to cash, and I'm going to be using some pages from our textbook as well as our notes. Okay, so internal control for cash is important for two reasons. First of all, the volume of cash transactions is enormous, and so the risk is significant. Secondly, cash is valuable, portable, which means easily carried and moved, and owned by the person who possesses it. In other words, there's no identifying characteristics of a dollar or $10 or $20 bill that would identify it as yours, so who's ever holding on to it is deemed to be the owner. Now it says in our text in our notes that the primary internal goal for cash receipts is to ensure the business receives the appropriate amount of cash and safely deposits it in the bank. I would go one step further, and I would say that it's most crucial to get that sale recorded, because if the sale is not recorded, most likely the money is not going to go into the bank. Now we'll first take a look at controls for receiving cash, and let's look specifically at cash received in person. Right now there's less cash transacted and more is done by credit cards and debit cards than in previous years. However, there is still a large amount of cash transactions. So first, cashiers collect and issue a receipt at the point of sale. Supervisors take custody of cash at the end of the shift and deposit in the bank, and then the accounting staff takes care of the records. Let's look specifically at how the activities built into an internal control system for cash receipts satisfy what we said were the control activities. So we're going to look at how the various steps employ these control activities. I apologize, there's a little bit of a shine because of the light on our document camera. So I'm going to have to adjust this here and there just so that you can see it. So the main control is to segregate duties. So we've got the cashier who's handling the cash and making the sale, the supervisor who's going to be comparing the cash to the records, and then the accounting department who's actually going to be entering the transactions into the accounting system. Okay, so let's take a look. There's less of a shine here. Let's take a look first of all at the cashier's duties, and where you work may differ slightly from this. However, all retail businesses have some type of cash internal control procedures, and if they don't, they're opening themselves up for theft. First of all, there's some way to record the sale. Most often that's a scanner, and as you scan the item, that documents the sale. Very important to get it recorded, because if you don't record the sale, it's less likely that the money will end up in the bank. Then customer payment is collected, and remember we're talking about cash procedures, so the cash is collected and it's immediately put into a cash register with that, which then restricts the access of other people to that cash. And then thirdly, at the end of the shift, the cashier prepares a cash count sheet which documents the cash collected during the shift. Now I just want to let you know that if you don't count your drawer at the beginning as well as the end of a shift, potentially your supervisor could be giving you a short drawer, which means less money in the drawer than they should be, and then blaming that theft on you. We caught a person doing that at a local car wash gas station that operated, and after it happened to the third employee, it took the management a little bit, but they installed cameras and began watching what the supervisor did and found out that he was actually shorting the employees. So you don't want to get blamed for a short drawer. Count your money at the beginning of a shift as well as the end of a shift. Okay, so then the supervisor compares the cash in the register with the cash count sheet. Sometimes the supervisor will watch or recount the money along with the employee. Sometimes there's a camera. There's a variety of ways a supervisor can verify the amount of money in the drawer. And the control activity that satisfies is that they independently verify or check your work as a cashier to make sure that the cash received equals the cash count sheet. And then they store that cash in a safe or vault box, and that again restricts access. So that is another control activity. And then finally, after all the money is collected, they complete the bank deposit slip, and that documents the deposit itself. Okay, the accounting department then gets the cash register records, and they compare that with the cash count sheet and with the bank deposit slip to verify that the money that was received was all deposited. So again, we have checking on another's work, independently verified, and that the sales revenue equals the cash plus any electronic payments received. Notice that the accounting department never handles the cash because you want to separate out asset custody or access, which means access to the cash, from the record keeping. Okay, so once step 7 is verified, then here the accountant prepares the journal entry. I'm going to zoom in a little bit for that. Sorry, zoom is the other way. The accountant then debits cash for the amount of money that was actually on the deposit slip. They credit sales revenue for the amount of sales from the cash register records, and then any difference would be recorded as either cash over or cash short. In our example, the cash received was $6,097, and there should have been $100, according to the cash register records. So the difference of $3 between the cash deposited and the cash recorded by your register in sales, $6,100, the $3 difference goes into a cash short account. If it were the opposite, if there was more cash received than recorded as a sale, it would be used in the credit position as cash over. Okay, that's cash received in person. Now what about cash received electronically? Oh, I'm sorry, cash received by mail. Let's zoom out a little bit now. Okay, the safest way to handle cash received by mail is through a lockbox. Oops, sorry, here it is. Through a lockbox. And a lockbox is simply a post office box that's owned by the bank, and checks go immediately into that lockbox, and the bank puts them right into your account. You don't have to hire anyone to process payments as a person who opens the mail to receive checks. The checks go directly to the bank. And that often happens with places like Niagara Mohawk or National Fuel Gas when you're handling payments by mail, checks in other words. If instead you decide to receive checks by mail, you would have either one or two mail clerks open the envelopes. If you have two, one can verify that the other one is handling it correctly. Basically, the envelopes are open and the checks are stamped for deposit only. The amount is compared to the amount on the remittance advice, and remittance advice is simply the portion of the bill that you have to return with your payment. It usually has your name, address, and your account number on it, and a place for you to put the amount that you're paying. So the clerk compares the amount of the check to the amount that you say you're paying, and then they record that. They list that on a cash receipts list. And then the remittance advice goes in one pile, and that goes to the accounting department. The checks go into another pile. Now it says the clerk should be supervised and should stamp all checks for deposit only. We've already described that. Sometimes there's a second person, as I mentioned. Sometimes there's a camera on them. It depends on the business and how much money they have to be able to pay people, very frankly. If it's a small business, they might not be able to afford a second person. They may use a camera instead. After these steps have been completed, the cash received, in other words, the checks, are separated from the records. The checks and the money orders are given to the person who prepares the bank deposit, so perhaps the treasurer or the chief cashier. Whereas the receipts list and the remittance advice go to the accounting department, and they're the ones who prepare the journal entry, debiting cash for the amount of the total deposit, and then crediting accounts receivable for the amounts that those customers have paid you. Cash received electronically is actually even safer than the use of lock boxes. And this eliminates the need for some internal controls because the amount is electronically transferred between the customer's account into your account. The company merely records the journal entries as a debit to cash and a credit to accounts receivable. So the safest way to receive cash is electronically, and the second safest is to use a lockbox if you are going to be receiving checks. Okay, so now let's talk about controls for cash payments. And the main goal in recording or controls for cash payments is to make sure all payments are made so that the business is paying only for properly authorized transactions. Most payments are made either through electronic funds transfer or by check, because both of those require a series of authorizations, and you're less likely to have payments being made when they shouldn't be. We usually pay employees via electronic funds transfer. Sometimes we call that direct deposit of your paycheck. In rare cases, we have companies dispersing cash, bills and coins, if they have a petty cash system, and this is only for emergency payments, and we'll talk about that in just a moment. First, let's talk about payments for purchases on account. Most often, a voucher system is used. And a voucher system is simply a set of approvals to make sure that you aren't paying for things that you shouldn't be paying for. Now I'm going to again take a page out of the textbook. This is page 224. I like this because it describes the step, the document, and then the control procedure. And again, I apologize for the bit of reflection that you see. So I'm going to have to move this back and forth so you'll be able to see everything here. So when a business is small, they're not going to be able to use this complicated voucher system, a process for approving and documenting all purchases and payments on account, simply because they wouldn't have enough money to pay all of these employees. So a sole proprietorship or a smaller business would have the manager or business owner be the person to perform a lot of these tasks. Okay, so let's say the first step is that there's a department within your company that needs goods or services. So the first step is to place a purchase requisition, and all of these forms document procedures, and they are all pre-numbered. Remember we said that that was a good step, to have all of our documents pre-numbered. And by having the department needing the goods or services, that ensures that the request is made by someone who is authorized or approved to place that. Now it says that this is to establish responsibility. That's the control principle. That's true. Who's placing the order? But it also documents that the requisition was made, so it also satisfies that control principle as well. Now the requisition goes to the purchasing department, and the purchasing department orders the goods or services, and they prepare a purchase order from a list of approved suppliers or vendors, so they couldn't create a fake company, sometimes called a shell company, and simply pay themselves. So it states that this restricts access. It does to only approved suppliers, but it also creates a record or a document of the process, and so it fulfills the documenting procedures principle. It also does establish responsibility because you have this only done by the purchasing department, not by anyone in the company. In the third step, after the purchase order is sent to the authorized vendor or supplier, the vendor then ships the goods. So the company receives the goods or services, and they prepare a receiving report. That's done by the receiving department. And on the receiving report, they get a copy, actually, of the purchase order. But we never tell the receiving department how much we're ordering. That's because if extra comes in, someone might be tempted to take the extra items home. We give them a spot to put in the quantity received, but we don't tell them how much we ordered, and that way it ensures an accurate count of what was ordered. So the receiving report prepares a list of the goods received, so we're documenting the procedure. It also goes to the accounting department, so that the accounting department knows how much to record the liability for. We're separating out our duties here, making sure the record keeping is separate from the handling of the goods. Let's see, we've got step number 4, and that's obtaining the bill. Once the goods are received, the supplier sends out a bill, and there's our supplier invoice. And we check this to make sure the supplier is charging only for the item that is received. So the accounting department independently verifies all by comparing what was ordered on the purchase order to what was received to what is being billed, so the company is not paying for something erroneously. So it independently verifies, and then they prepare a journal entry to record whatever's purchased and credit the liability account. So they're documenting procedures again. And they usually use a voucher to do that, either an electronic voucher or a regular voucher, which is simply a folder that includes all the documents and then a place for them to sign that they approved the entry of this information into our record-keeping system, and then a date that that's due, and a place to indicate paid when indeed it is paid. And that's the last step. To write the check or initiate the electronic funds transfer to actually pay that bill. So it's not the accounting department, but the treasurer's office that writes that check. Remember, the accountant can never have access or custody to the cash. So we use a pre-numbered check and make sure that's in sequence. That documents the payment. We make payments only when a purchase is supported by the complete voucher. So someone in the treasurer's department goes through all those same documents that the accountant does. Then the voucher is marked paid after it is paid to prevent a second payment, again documenting procedures. And finally, they notify the accounting department that they can now record the payment, so debit accounts payable and credit cash. And again, we're separating out the handling of the cash from the record keeping or journal entries. And as I mentioned, a small business could not possibly hire enough people to do all these duties, so the owners would have to participate in more of those activities than their employees. And the owner should always reserve the right to be the only person to sign a check, because there's many instances, and we will look at these in our next mini lecture, where bookkeepers or accountants steal money by forging checks, or if they are allowed to write checks, they write them to themselves. And we always want to keep bookkeepers and accountants away from the money. Okay, so we just talked about cash paid by check for purchases on account. Now let's talk about cash paid to employees. The safest way to do this is through electronic funds transfer, also known as direct deposits. So after the payroll reports are prepared, the company initiates the electronic funds transfer, and it tells its bank to transfer pay to each employee directly from the company's bank account. Often the company has a separate checking account just for payroll, and they put only the amount of money in there necessary to cover all the employees' checks, so that if the bank made a mistake and overpaid an employee, the account would not have enough money in it to make that disbursement. So, as I mentioned, that reduces the risk of the bank accidentally overpaying or underpaying the employee. And that's called an imprest system. It restricts the total amount paid to others by limiting the amount of money available to be transferred. So you only put in the total amount of money to be disbursed as take-home pay, no more than that, to prevent the bank from making an error. And you can also use an imprest system when you're using hard copy checks as well. You only put in the bank account the amount of money that the employees will be cashing their checks for. So if someone altered a check to try and be paid more than you disbursed, it would show up right away. Now let's talk for a moment about cash paid to reimburse employees for any payments that they made on the company's behalf. This will be our last topic because we're going to be covering controls from bank procedures with Learning Outcome 5-4. So let's talk about a petty cash system. I'm pulling this out of our textbook. This is page 233. A petty cash system is a small amount of money that a company keeps on hand for emergency cash payments that are usually reimbursements to employees. For example, perhaps your company was named in Business First magazine and you sent an employee out to buy 4 or 5 copies of the magazine. Or an employee has to take some type of transportation somewhere to be able to pick an order up, or any type of emergency payment where you're reimbursing an employee. Let's take a look at that. First of all, we put money into a fund. We estimate how much money we think we might need to pay out over the period of the next month, for example. And then we establish who is going to be the person to run the fund. We then write a check to cash for the amount that we're going to keep in the fund, and we cash it at the bank, and we bring the cash back and put it in a locked drawer or a locked box. $100 in this case is the amount of petty cash we're going to keep on hand. And then the custodian or petty cash cashier determines when to make payments out of the cash box using policies and procedures established by the company. And as evidence, when they disperse cash, they fill out this petty cash receipt form. This documents the procedure. It's got the date, who's receiving the money, the reason, the account to be charged. I apologize. There you can see it better. The amount of money, the date, the reason, what account is going to be charged, and then the petty cashier's or petty cash custodian's name, as well as the person receiving the amount of money. As you are writing out these receipts and receiving the cash, you're not doing any journal entries at that time. But on any given day, the payments out of petty cash plus the remaining cash should equal the total amount of the fund, $100. Payments out of petty cash are not recorded in the accounting system until it's time to replenish the fund. But on any given day, the receipts plus remaining cash should equal the total of the fund. And then in the last step, the fund is replenished. So either when the cash is getting low or when it comes time to do the financial statements, because we want to make sure we get all the expenses recorded in the right period, we take all those receipts and we debit the appropriate accounts for whatever the amount or the amounts were dispersed for. So here we have supplies, travel expenses, and office expenses, and then $67 is the amount needed to replenish the fund. Now, I'm not going to give you any problems dealing with petty cash, but I did want to make sure you were familiar with the procedures because a lot of companies have petty cash funds. That ends our second mini lecture, and actually our next lecture will take a look at actual real-world examples of employee fraud, and then after that we'll deal with bank reconciliations and learning outcome 5-4. Have a nice night.